In today's video, we're going to be talking about how to manage risk as a day trader. And it's not a fun topic, it's not an exciting topic. When we're into day trading, we only want to hear about the wins, how much money we can make, and just all the positive. And that's great, but it's not the reality of day trading. Day trading comes down a lot to just risk management. I've told this many times to all my students through the years. The difference between a profitable trader and an unprofitable trader 90% of the time is just that one manages risks better than the other. Because they could probably both have the same technical analysis skills, the same idea on where to find a setup, what's a profitable trade, profitable entries and PTs. But if one is not managing risk correctly, they're going to lose their account regardless. You could hit 100 green trades in a row, but 101st, if you're not managing risk correctly, you could blow up your whole account. There's going to be really important videos on how I manage risk, how you can build a proper risk management plan that fits best for the way you trade, if you're in a prop firm, if you're not a prop firm, that's, it's always going to be dependent. There's no one size fit all on how to manage risk, how to enter a trade, because all of our accounts are different. We all trade different instruments, and some of us are on prop firms and some of them are not. So in today's video, we'll talk about how I manage risk, what has helped me to manage risk, and maybe the same way that you could take some stuff from this video and apply to your own risk management plan. I want to get this myth out of the way right off the bat. When people are risking exact amounts, all right, so I get this question asked all the time. They're like, oh, should I risk $20, $200, $500, whatever it is? And it's like, I always tell people, if your risk is an exact dollar amount, you do not know what you're doing trading-wise. Your risk should never be an exact dollar or an exact tick size, versus it should always be, where's your trade invalidated? Your trade, you should get out of your trade at the point where like, hey, it's telling you the charts or the symbol's telling you, hey, you were wrong at this point and you need to get out of this trade. It should not be just because you're down $200 or $50, wherever your risk is, you just get out arbitrarily. Trading is not about just the dollar amounts. The market does not care. They lost $200. The market is going to follow its structure and it's gonna move depending on where price is. So your trading, the way you should always manage risk, I think no matter what, is always going to be look for where you're wrong on that trade. And if you're like, hey, the point where I'm wrong in this trade is just too far for me and I cannot take that kind of risk, then maybe your entry should not be where it is if you're risking a little too much. Let's go over a quick example on how I would take a trade or look at a trade depending on my risk. So let's say we have, here's our chart, and we have price at $100 here, and price $98, and price at, we'll make this a little further. Again, I'm just gonna use random numbers to just look at how price will move. So then price is moving within this range, up and down, higher lows, higher highs. And you're like, hey, I'm looking for a breakout over this range of $101. Let's imagine it's on 101. And I'm gonna take TPs at, do this at 105. Next area of resistance at 105, right? So you are waiting for price to break, and you can enter at 102, and then you can risk again back into this range at $100, right? So now you're risking $2 for a profit of $3, right? Now you're gonna ask yourself, like, is that a good risk to reward? For me, anything above a 1 to 0.5 R is a good risk to reward. People have this assumption that every trade should be 5 R, 10 R, 20 hours, and they're gonna come to you those trades, but going to a trade, always assume you're gonna catch a huge winner, will bring down your win rate a lot, because your risk to reward and your win rate are closely correlated, and high risk to reward trades don't happen all the time. So if you're going to the markets expecting every trade to be that, it might hurt you. So you can assume a 1.5 R, and then depending if on your risk, is $2 risk too much? Let's say you enter with, this is 2 points, right, on a Q or something like that. Is that too much? You're gonna have to ask yourself those questions, and you're gonna have to find out if that makes sense for you. Let's talk about another myth that people seem to, not a myth, but another thing that people like to trade is with hard stop losses versus soft stop losses. So I, for one, never really use a hard stop loss. A hard stop loss is like, hey, you set an order. Let's say you enter this trade at 100, and then you set an order at 98 of a hard stop loss. As soon as price, and then you have a target of 105. So you enter 100, price moves, comes down. As soon as it taps, even if it wicks right back up, you will be stopped out of this trade. Because at $98, you assume, hey, that's where more than likely price is going to hit, and my trade is completely validated, right? Then you expect price to go down. Now, I personally do not trade with hard stop losses. I will have this $98 area in mind, but I will wait for a 5-minute candle close more often than not to close under it, because I don't want price to wick back above it. And now that is something that you have to take into account with risk management, because let's say you had a 98, maybe you flush fast under it, and then you have to close at 97, and now you assumed one more extra dollar of risk because you weren't fast enough to close it. Now this 5-minute rule, it's not a law. It's not like I always wait. I'm looking at the price too. If price looks extremely weak, I'll just close at 98, or maybe I'll just give it just a tiny bit more room, but I'm not gonna wait till the 5-minute close. Right? So that's more of an idea that comes with experience, not having a hard stop loss. I will recommend it for a beginner. Hard stop losses are always the best because you might not have the experience to be with as taking a little more risk, or the experience to look into the trade and understanding like how that emotionally how to hold that position. So if you're a complete beginner, I would say stick to your hard stop losses. If you're not a beginner, try out the soft stop loss and assume that you're gonna have always an extra dollar into your risk management. That's kind of the way I always look at it. I know that's like maybe I'm risking $500, but more than likely I'm gonna be risking like more around $600, right? So I have that kind of in the back of my head when I'm entering a trade. And also it is a little bit easier for me to take risks into the markets because I've already made a good amount of money from the market. So it's okay with me taking more risks. If you've lost a ton of money, it is not okay for you to take in more risks if you're not okay with it. Now, another point I would like to mention with risk management is before you enter a trade, let's say you have $100 again and $102, and then you have your $98 here. Before you enter your trade, always look. Let's say you plan to enter 98 and 99 right around here. You're going to enter to target 102, and 98 should be your stop loss, right? So it's going to be your stop loss, and this is going to be your TP, and this is going to be your entry. What I've noticed through the years of a beginner trader is a lot of times your stop loss should be where your entry is. We have to understand the market tends to want liquidity before it needs to move strongly towards one direction, and it makes sense, right? We need a lot of orders to push price, make the price volatile, and push it towards right direction. And beginners, a lot of time, you will have the right idea but the wrong entry. So before you enter a trade, if you can, give it an extra minute and look at where your stop loss is. More often than not, your stop loss will be where your entry should be. So then you either entering 99, you should be entering 98 with a stop loss at 97, and then targeting 102. So I found this to be very true with a lot of beginner traders. Okay, so I want you to add that to how you trade. Look for a stop loss. Look where your stop loss should be, and double check if that should realistically be your entry. I promise you, a lot of times you're gonna find this. Like 50% of the times, you're gonna find that it's true, and you're going to enter where your stop loss should have been, and it's not only going to bring up your win rate, you're not going to get stopped out, but it's also going to make you give you a higher risk reward rate, right? So now we also talk about how we were talking about earlier about R multiples and risk reward, right? Should you be aiming for 1 to 2, 1 to 3? We hear this all the time, right? 1 to 3 risk reward trades and all these sort of things. Realistically, your risk to reward should always be in a positive, but it does not have to be. You're going to have to find out what is your win rate percent based on your strategy. This is the issue. Like, what is your strategy win rate percent? My typing is terrible today, my drawing. And I found with mine over the course of like my lifetime or course of the year, it's always going to stay above 75% at the minimum, right? At the minimum, it's going to be 75%. A lot of times it's going to be 80%. A lot of times it's been 90% over a course of a month. And with a high win rate, I understand that I can be very profitable if I have a 1 to 0.5 R. So I'm not looking for home run trades. The home run trades, if I have runners, so I'll take most of off in my 1 to 1.5 R trade. And if I have runners, I'll let them keep going. And sometimes I do catch the home runs, but I'm not looking for home runs. Now, I'm not saying this is the way you should trade. This is going to be only dependent on your strategy. if you have not backtested the strategy, go to tradeful.net. I'm creating a backtesting software that will help you a ton. We're going to be coming out in the next couple months. So go to tradeful.net, put in your email. I'm going to show you guys real quick. Tradeful.net. You put in your email right here. You're going to stay up to date. We're going to do giveaways. We're going to do a ton of stuff. So go to tradeful.net, and this is the only way you can understand what your R multiple you should be aiming for. Because depending on your strategy, you have to see what your strategy win rate is, one, and what PT gets hit the most. So let's say you have a set of 3 PTs. You can be more profitable if you hit PT 2 80% of the times. You should be closing most of your trade there, not taking any at PT 1. Right? So the way you adjust your PTs and your R multiples is going to depend on your win rate and on your strategy. Right? You also understand if you look for what is the likelihood of a 1 to 10 R trade. Right? It's only going to happen 10% of the times. So if it only happens 10% of the times, you have to understand that whenever you take a trade, it only happens 10% of the times, your win rate is only going to be 10%, right? If you're like, hey, if I take 100 trades and only 10 of them hit a 10R, then maybe my win rate would, my win rate doesn't make sense for me to still be profitable at a 1 to 10 or 1R multiple and 10%. Because also you got to understand that it's like if you're only hitting it 10% of the times, you might blow up your account before you get there, right? Also, since we're talking about account sizes, is should you always be trading with the same size? I've always been a fan of not trading with the same size. I've always been a fan of understanding that the market is not always going to give you an A+ setup. And the only way you're going to understand with your A+ setup, again, it goes back to backtesting. You understand, okay, what is your playbook? We all have a playbook. For example, mine, I have 10 AM reversal, right? I have the right side of the V of the trade where I want to be. Maybe I'm looking for golden pocket retracement after liquidity sweep with a fair value gap combination, right? These are all setups that I take. And now if I get a combination of like, hey, we're on the right side of the V, it's at 10 a.m., it's a liquidity sweep plus fair value gap, that's everything I want. It's an A+ setup. I've always been a fan of getting in more into that trade. And secondly, adding on to your position. I'll be showing you guys a trade that I took and how it's something I don't talk about all the time, adding on to position size, but it is something that I found can be very profitable over the long term. Over long term, what we do as beginner day traders, or as just day traders in general, is we want to take profits too soon, and we want to cut our losers too late. So let me show you guys a trade real quick that I took and I added position size to it, and I explained to you guys why I added position size here. Let me go, make it smaller right here. So this was on Wednesday. On Wednesday, we took a short position. So why did I take a short position on NQ? Number one, this was right here. You see this zone right here? This was the daily fair value gap right here. So on the daily time frame, I don't want to mess up the screen, so I'm not going to change it, but it's a daily fair value gap. So I told myself the halfway point of fair value gap should be a potential area of rejection, right? So I'm going to enter the daily halfway point of the fair value gap, which I did. As my risk, can you guys see what my risk is? Now there's two ways you could play this. You can risk here about 10 points at the new high, or if you close above, or you can risk this previous day closing price. So at the time it would have been right here. So this is what it came down to you. I was risking if price closed outside of the daily gap, again, with a 5-minute close. So roughly I was risking about 15 NQ points. Again, this is a waiting for the kind close, give it a little more room, about 20 points on NQ. I was risking, which I think is fairly safe to it's fairly safe. And then my first target would have been down here. So this would have been this 5-minute fair value gap in case price went to just retrace there and bounce. And then my last target price would have been new lows for the day. So this is the daily opening gap, and that would have been kind of my PT was. So overall, I was risking about 1 to 7 here. If we after taking PTs or whatnot, more likely it was going to be a 1 to 4. Now in this trade, I was quite confident, guys, with a large time frame, daily fair value gap, to get filled. We also had an SMT divergence. So we had a divergence, yes, when NQ made this new high, yes, and no made a new high. So that kind of tells me that price was very weak going to the day. So I entered here, we came here to our first TP. I took first TP, and we bounced up. What didn't I do? I didn't just get out here because I'm like, oh, I'm scared. Price is going to come back and I'm gonna get clapped. I didn't get scared. A lot of people did. I actually added to my position. I mentioned it to the chat, added to the position. Again, targeting the same, and then I had runners. So I'm actually doubling down on my short position, took profits, came back up, added more to the position, and then boom. Because why? The market's giving me what I want. I should expect a bounce here, but the overall larger time frame analysis, looking also at the S, is still telling me that this is very bearish. Why did I add here? Let's go to the 1 minute. To go back all the way right. That was Wednesday. Let's go back to Wednesday. This is Thursday, so the day prior. Wednesday was right here. We had left a 1 minute for value gap didn't get tapped into, which was right here, but we didn't come all the way up to it. But what I did was, sorry, where's my Fibonacci tool? I saw wherever my Fibonacci was from that pool. Why can I not hit the Fibonacci tool? There you go. Look where we came right back up to, right into the golden pocket area on the 5 minute, also on the 2. If you look at different time frames, you see, look at that, we hit right into that fair value gap there, and then boom, I entered. I added to my position. The larger time frame was telling me I was right. I was able to take some PTs. I was able to get a retracement to continuation to that price. And again, look how aggressive this move down was, right? And then give us all the PT. So when you're right, double down on your position side sometimes. No, I'm not saying all the time, but add to your winners. A lot of times you have the right bias. A lot of times you have the right ideas, but you're just closing the trades too early. You're ruining your R multiple. You're ruining your risk management because you're cutting it too early. You're lying to yourself, right? If you tell yourself like, hey, this was my full RR, but you took 80% off here, and then you could close the rest here. Realistically, your RR was like, like this. It's not really like this whole move here. So you have to be honest with yourself, and you have to understand where you can improve to make better trading ideas. And a lot of times it's sizing in. We're sizing in too heavy, and we're closing just way too early. So do this in your trading. I promise you your risk management will get much better. I promise you'll see a lot more profits, because if you master your risk management, you're going to master your profit in your trading. As always, guys, subscribe down below, and peace.